Hello everyone. I hope all of you are doing well. On this video session today, we are going to discuss about how someone can develop a profitable, consistent trading system, day trading system. Also, we are going to discuss and talk about our own strategy and the system which is live since August till now. And for any of the questions during this video session, please reach to our website on contact page and please submit all your questions and queries here. Also, a quick disclaimer before we start. All the informations and the discussion on this video are for informational purposes only. They are to educate you, they are to equip you with some understanding of market. Please understand markets are risky and investments has to be done on your own risk. With that, let's kickstart. In Trade Together, what we try to do is we try to analyze the market from mathematical point of view. Our whole approach is based on mathematical point of view. What we try to do is we try to collect different data sets in the market. We try to develop a model using those data sets, and then we try to understand how market behaved, what were the events in the data which were happening before the move in the market, and based on that we try to come up with something useful for future. For any system, for any trading system, there are a couple of things which are very important, and in Trade Together we have such systems in place. I'll give you a quick understanding of what I'm talking about here. So for any working solution or any working trading system, the first thing which you need is edge. Then the second importance is hedge, and then the last but again very important is execution, the way you execute your trades, and platform, what tools, what systems you use to trading. So I'll as I explain, I'll give you a quick understanding of how we are doing it, so that it's very simple and easy for you to understand. And also, if you have any issues, you can reach out to us, right? So for hedge, in Trade Together, we have developed a machine learning algorithm which basically looks into the data, the patterns which are occurring in the data, and based on that it tries to figure out how the market would react in, let's say, next 1 hour or 2 hours. We do not stay in the market, not because of some constraint, but we don't like to stay in the market or keep our positions open overnight. So all the trades and the stats and the profits you're going to see are purely intraday profits and trades. We do not keep any money in the market once market is closed. We go in the market once market opens, and we get out 10-15 minutes before market closes, and whatever profit and losses are actualized, we accept those and we move forward for the next day. This is done mainly so that when suppose something happens wrong at night or early morning before market opens, you are safe, you have no worries, and you know your risks are manageable and quantifiable, right? So this is our edge, a machine learning algorithm which basically helps us to identify when market is bullish, bearish, when market is sideways, and it also helps us to pick a right trade. Then the hedge comes. Hedge is important because once suppose you know market is going to go up, there are many ways you can enter into the market. To maximize your profit potential and to reduce your losses, you have to choose the best possible method. Let's suppose there is a stock which is expected to go up, suppose 5% up from the current price point. You have two options. One is to buy the stock in a cash market, or you can buy the futures, or you can buy the call option. Now, out of these three available asset types, you have to choose the one which is best effective. If future is trading at a discount rate, you can make the similar position using futures. You would get a benefit if if future goes on premium. um, Similarly, you can use options, you can use cash based on the right situation. In Trade Together, what we do is we have developed a separate algorithm which is having all sort of different strategies learned by itself. um, and what it does is it analyzes the market condition, and based on that it creates an option strategy, which can be deployed in the market. Now, option strategy, when I say, we do not believe in either one-sided option buying or one-sided option selling. We try to create a mathematical model of a position which can go in our favor. So for example, if our edge, our system or setup is suggesting to buy, go long, the hedge would create a combination of option buying and selling in a such way that even if market goes against us, let's say 0.5%, we don't lose any money, right? So that kind of a strategy is developed based on the market by the algorithm and is given to us live in the market. Now, once you have the strategy, the next step comes is the execution and the platform. When you are executing a trade, it's important how you're executing it. You could choose to execute in the market, you could choose to chase your position, get it filled properly, or you could just put a limit order and wait for it to get filled. It depends upon what kind of execution mechanism you're using. And the last and very important part is the platform. Whether you are trading using your laptop, desktop, your own home internet, or you are using Google Cloud, Oracle Cloud, or any cloud platform which is provided by these companies, to ensure even if you lose a power, you have, or use internet, you have your system running, right? So that's what it says. When we talk about platform, it also covers the tools you're using. So AMI broker could be one tool. Similarly, there are Nest, there are so many tools which you can use. But in Trade Together, what we do is we don't use any of these tools. We only use a core programming to design the trade, to execute the trade, and the trade goes directly to API and gets back. Also, to manage the trade, we don't use any tool. We get the data from our portfolio and manage it based on our handwritten code. So everything what happens in our strategy is basically hand coded by ourselves. We do not use any tool from the market. It is just done so that we can scale up, and also we can create a complex strategy, because sometimes when you use a software, there are limitations which you can't pass through, right? So that's why we have hand coded the whole system, the entire system for us. Now, when we say edge with Trade Together covers these 5 dimensions of the data. The first data which we try to analyze is real-time price data. We take that data from our data providers. It comes to our database, which is situated in Google Cloud. I'll show you the sneak peek of one of our account. Once the data is analyzed and we understand the pattern is, let's say, bullish, then we go to market profile analysis and volume profile analysis to understand 2 key things. One is where market stands. Let's say if market stands on the edge where you can only see 10 points upside, it's not worth risking 10 points. It's not worth risking 50 points to just simply take 10 points, right? That's not a favorable trade. So we try to understand where market is right now, whether it's on the edge, it's on the bottom, what is my current trade, whether it is going to favor us, whether it's going to whether it is disadvantages, what's my risk reward. And then we use volume profile analysis to understand how players are working. there is a theory which I like personally, which is called chaos theory. And volume profile analysis can be done to basically get a story out from the market in terms of the chaos theory, right? So you can understand how people are buying, selling a specific stock, and you can also understand when people are silent, when there is not too much chaos, when there are not so many people involved, volatility is less, how the stock is behaving, whether a stock is going up when there is no chaos, whether it is a stock is going down when there is less amount of participation. So these are the things which we try to understand from the volume analysis, right? Then once we have these two data sets aligned from a price and from volume profile, we go to sentiment analysis. Now, sentiment analysis is a very broad topic. I can have a full session on this one. But basically what we're trying to do is we're trying to understand the sentiment of the participants, whether people are bullish in the market, bearish in the market, and what's the gauge of the fear. If you know, India VIX is one way you can gauge the fear in the market. If you're talking about S&P 500, you have a VIX there as well. So VIX helps you to understand and gauge what's the level of fear in the market. So with that and some social media analysis, we try to understand what's the sentiment right now, and we try to align these three with each other. Even if this goes beyond of our these two analysis by, let's say, standard deviation of 10%, we try to discard this. So this is not a key factor, but this is something we count. If this gives us a boost on the confidence of our signals, right? So we do that. Then once we have these three things checked, we go to future data analysis and options data analysis. Futures data analysis and options data analysis basically allows you to do a couple of checks on that particular stock, and what you try to understand is how a smart money is positioning itself. Sometimes you understand the market is at the resistance point, market is going up, but there are a lot of people, those who are shorting here or expecting market to go down from here, right? So these kind of analysis basically helps you to prevent entering when market is at the top, and also when selling when market is at the bottom, right? So understanding where we stand, how far we are from the resistance, how far we are from support is can be done using the analysis from the future data and the options data. When we do the option data analysis, we also feed this data back to our strategy, which basic as strategy builder algorithm, which basically picks up the most liquid option, and also it picks up the option where most of the people are sitting with position open, similar to where we are. That is done to boost the confidence, of the trade, and also to ensure that the trade which you're taking is not completely contrary to what larger market participants are doing. These larger market participants are not the retail people. Most of the time these are the banks, the big guys, the big pockets, those who are trying to understand where market would go. So this basically helps us to park ourselves in the right quadrant and take us to the right side of the trading. Now, once you have all these 5 steps done, then you go to the entry time analysis, understanding, let's say if you are a day trader, it is important that you do not create a new position when last 15 minutes of the markets are active, right? Because market can close against you and you literally can't do anything. You just have 15 minutes to act. So this can be one example for a intraday trader. For positional, you should know when results are about to come. When you're creating a position, you should be aware of whether this stock is going to release its quarterly results or not. or there is any other event schedule like Fed rates and review, and all these things basically helps you to minimize going into the wrong zone. Now, wrong zone could sometimes favor you, and wrong zone could sometimes cause you a big loss. What we want to do is we want to create certainty with our system. That's why we are using a setup, right? We don't want uncertain profits, as well as we also don't want uncertain losses. Profit everybody welcomes, but when you accept uncertain profits, definitely someday you're going to get uncertain losses as well. This is how it works. So entry time analysis basically helps us to understand whether there is any event about to happen, whether market is about to close, whether market has just opened. All these checks are important before we go and punch our trades. Then the next step is selecting the most effective strategy. So for this, in Trade Together, we use our machine learning algorithm, which creates a mathematical model combining option buying and selling, which basically rigs the game in favor of us. So if market goes in our favor, we make money, and if market goes against us, we don't lose too much, we lose little bit, or we come out with little bit amount of profit. It depends upon what is the condition of the market, and then based on that we try to punch that strategy. Now once the strategy is in place, the next and most important thing is position sizing. Suppose if you have an algorithm with the odds of winning 50-50%, then your position sizing, suppose if you're sitting in a wrong when market is going against you, if you're in that position, you want to be as small as possible so that you can reduce the losses. And when you are in a trade, when you expect profit, you want to be as large as possible so that you can increase your profits. Now it doesn't happen that way. We want everybody wants this, but it doesn't happen that way. So what you do is you take the data from your edge, from your setup, and based on that data you try to understand what statistically can happen with this trade, what are the probabilities, how much profit and loss can be made if you go in, and based on that you can standardize how much amount of money you're going to use from your portfolio. So let's say if you have a 50-50 chance or a win-loss ratio, then you would be using a position size of about 35%, so that even worst case scenario you are wrong 3 times, you can use the exact same size for entering in the position. Once you become profitable, you go in, you have made some money, right? So this is basically called position sizing. Always remember, position sizing is a function of risk. If you increase the risk, position sizing will go up. If you increase the position sizing, risk will go up. And the risk in the market is a function of a volatility. Okay, that's also very important. If markets are high volatile, whatever stop loss and target you would hit, market will touch both of them, but first it will hit your stop loss and then it will go and hit your target. So this is important to understand, that when we take a position sizing, we take in account how much I'm okay to lose, and also we take in account what is the current volatility of the market. If market is moving 100 points up and down, then only buy one stock, right? And if market is going 1 points up and down, you can easily buy 100 quantity of a stock. It will level out and stabilize your profits as well as your losses. So this is what we do. Basically what I have just said, this is what our algorithm does. It figures out what is the volatility of the market, how much amount of max loss can happen in this strategy, and based on that it decides the position for entry. Now when you decide what should be your position, the next step is the trade entry, where we basically go and execute our trades. For this, we have developed a separate component which basically picks up the current price where buyers and sellers are sitting, and it initiates half of a position and distributes the rest other half of a position, um, where with the quantified levels of noises. So we utilize noises basically in the market for our profit. I have another video I posted about 2 to 3 years back when we were researching about the noises in the market. You can check that video out. It's very helpful. You can use that noise to basically make some extra bucks of money in your trade, right? So this is what we do. We go in for half of the amount at a price, whatever is available in the market, and half of the position goes in at the noise levels, and then algorithm adjusts automatically that position until we get filled. And once you have a trade entered, the second most important thing is monitoring the trade, understanding what's your right P&L at this point in time based on your portfolio. Checking what's going on with your trade is very important. Then the last part comes as profit booking, when you decide either your stop loss is hit, whether you, or suppose, let's say you want to get out and book some profit. So profit booking is completely another, exiting is another completely big topic for discussion. Here we have our own algorithm which predicts at what time to enter, what time to exit. So we utilize the same for exit as well, right? So let's try to understand the hedge very well. I think edge and execution and platforms are two simple things to understand. I understand they are very complicated to build, but they're simple to understand. Edge is basically a strategy, a setup which gives you statistics of how your setup is going to work, how much amount of profit and loss you can have, what's the predictability, reliability of your solution. And then execution and platform is basically understanding what tools you have, what technologies you have, and what type of portfolio you have, whether it is large portfolio where you should create a solution, something like us. You develop something which chases the market, distributes the position so that you get a best rate out of the market, or you are a small player where you can afford to go and place a market order and take whatever market gives you back, right? So these two things are simple, but hedge is something people don't understand. And the most important thing to understand is why exactly we are using hedge, right? When we know something is going to go up, why to even bother about hedge? That's the biggest question. So we'll try to understand that, and we'll try to understand that in more detail. So let's take an example. Suppose you have a stock. We have taken for this example SBIN. This is SBI India, one of the largest public sector bank, the largest public sector bank in India. Now let's say if you go and your system tells you that market is going to go up, the stock is expected to go up for some reason, and your hedge is what you have to look for. Now if you just simply go and buy that stock, basically you're going to get this payoff diagram. I'm going to give you an explanation of what this diagram means very quickly. If you see the horizontal axis, this represents the price. This is the center price when market is right now currently situated, right? So this is zero line. If you go towards the left, you get a negative zone when market is falling, and if you go towards the right, this is when market is rising. So if you invest here, if you buy any stock here, if stock goes up, you keep on making money, right? You keep on going on this linear path. If market goes against you, you also start losing money at the same rate. The rate which you see here and the rate which you see here are exactly same. However, keep one thing in mind: when market falls and goes down, it falls very quickly and suddenly. But when market goes up, it goes slowly. Now, what you can do is, by utilizing different kind of assets like futures, options, and cash, what you can do is you can create a mathematical model of your position which can give you a profit when you are right as well as profit when you're wrong, right? And this is something which is very complicated. Even people, those who are professionals in this area, have hard time picking up a right strategy. So I can understand if you have some dilemma, but stick with me. I'll try to explain it in an easier language. If you have any questions and doubts, you can ask me on the comments. So this is one of the example which I have picked on a strategy executed by our algorithm about 3 to 4 days back. And this, if you look at here, this blue line is basically our payoff profit and loss diagram. What you see here is the zero line. Okay, this is somewhere in the center is our zero. So if market goes up, the trade was, by the way, bullish. So expectation that was that market is expected to go high, but at that point in time market was already sitting at a resistance point. Expectation was that if market goes high, it will go too high, otherwise it will fall quickly and go in negative zone. Actually market went up, it crossed that zone. So we ended up with the profits somewhere here in this zone. But when I was analyzing this trade after market, I understood how beautiful this hedge is. So if you try to understand what basically is happening here, if market is going up, we are making profit. If market is going down, you will have some small amount of loss here, because you would end up giving a vega in options, which is basically you can hedge it off. But let's suppose you have a little bit loss here, okay, few points, not too much, not even recognizable, but you will be having some losses here. And then immediately market will start going up, and your trade will start going up in your direction, making profit, right, against your direction, but it's still making profit. So this is what algorithm was trying to do, and this is the key point on using the right hedge. Suppose if you see the market is at the bottom and it is expected to go up, there could be two scenarios. One is you're right, another one is you're wrong. If you stand right, the result is it is going to bust up. But if you stay wrong, if your decision is wrong, market can crash down, right? The falls which happens at the bottom further are steep. So if that happens, what you're going to do? So you should be ready for worst case scenario as well as best case scenario. If you use a right hedging model, you basically end up managing both sides when you're right as well as when you're wrong. The most important thing is when we are wrong, we should lose least amount of money. If we are making profit when we are wrong, I think that's the excellent one, but we should not try to make profit when we are wrong. But when we are right, we should try to double our profits as much as we can, right? That's the most important systematic way of creating a hedge and trading. Now, if you can't get the another important thing is this model which you see would not be useful in every single day, every single time in the market. Based on the volatility of the market and the phase and cycle of the market, the availability of different kind of setups and strategies changes. At that specific point in time, algorithm found that this is the best model to work for. It could also happen that if it understands market is choppy, market is not violent, it's not sitting at the edge or at the bottom, it's somewhere in the middle, then we would just end up selling a call, selling a put on both sides and getting some premium back in next 2 to 3 hours when market moves up or down. There could be n number of strategies you can make when you use options and futures and cash. These three instruments, you have n number of options if you basically use the combination of these three. And the benefit which you get is right in front of you. If you are able to get this strategy, believe me, you can dump as much amount of money and you on your portfolio when you understand your risk is minimum, right? When you understand your risk is, let's say, only 0.5%, you can, and your maximum risk accepted is 3%, you can basically increase your position size multifold. And that's what is the power of hedge. And so I hope this clarifies what basically you're saying. If you see here, when I was checking and when I took this screenshot that day, it basically was on negative 3.2% and it was giving me about 5k 6k, right? So this is the key of hedge, and I would recommend anybody who's trying to trade in the market, do not go in the market without hedge. Otherwise, if position goes against you, you have to either quickly come out. You don't know when you are wrong and for how long you are wrong, right? Sometimes market goes against you, then it goes in favor of you. So it's the hedge which can protect you from sharp rises and sharp falls. Okay, so as you can see, data is in front of us right now for Nifty. Meanwhile, Bank Nifty is running. We will take a look at what we are seeing, what does it means, and how we use it, right? So the data what you're seeing gives you a Nifty historical results performance of this algorithm since 2015 till today. So what do we see here? The first number is profit percentage. That means when we are making profit, our profits are this much bigger compared to losses. So if you see 76% are profits, that means roughly about 3 times our profits are 3 times as compared to our losses. So we are making 1 point loss, we are gaining 3 points when we are right. Then this is total trades per day. So in every day per day we are getting 0.34 trades. That means in 10 days we are getting 3 trades by average. This means at least 1 or 2 trades every week. Now J and K are other parameters, I would not go into them. The P order basically represents the accuracy of this system. So in last 5 years, all the trades combined, 60.44% of the trades resulted in profit after cutting taxes, charges, and slippage, and remaining about 40% of those were in loss. Now, when we made loss, we only made a point loss, and when we made profit on 60% of the time, our profits were bigger, about 3 times. And this value doesn't mean, this means how much would be the total growth of portfolio, which is not useful for this video. Now, if you see further, you can see even more details about what was the loss percentage, what was the profit percentage. This is the same information, and this is a ranking which we try to estimate. All right, so the 2 things which are important for me to take a decision on this data is the P orders and portfolio percentage. What does this say is when I'm right, I'm 60% of the time right. That means if I am placing 10 trades, 6 trades will be profitable, 4 trades will be in loss. And I need to do a good job on managing and understanding those 4 wrong trades so that we can minimize the loss step. When you check the profit percentage, that gives you some breathing room that when we are going to write, we can cover up the losses made in last 3 trades, right? So based on that stats, what we do is we always use 50% of our cash to place our position. Let's say in first, if we are wrong, the second we are expected to be right, we can place the same order. And when we are wrong, we are only losing about 5% max, not more than that, in every day combining all trades. So that stats basically tells you how much should be your position, how you should look in terms of managing your risk size, at what time you should enter, what should be your portfolio value, and all that. Now this graph is we could not analyze it, but this is basically a graph of last 5 years. So to analyze it, you have to zoom down. So basically you can see for every successful trading system, you would definitely see some losses, right? So we also have some losses. If you look here, If the line is going up, that means it's profit, but when line is going down, something like here, it's loss, right? We have a little bit loss, small loss here, then again one loss, so we have three loss in a row. And then we have a profit which basically covered all the losses we made plus little bit gain. Again we had two losses, again next profit basically covered all the losses and a little bit gain. So like this, the journey goes for any successful trading algorithm. It is very important when you're developing such solution, do not try to be 100% accurately, right? Because when you reach to such a system, definitely you have introduced something wrong is there in your system, because of which it is giving you 100%, right? Even achieving accuracy of 70% is very, very tough. This is some sort of a top class AI trading algorithm performance, so you can compare how hard it would be to even touch a 70-75%. It's just beyond the capacity. But what best you can do is, if you manage your position size properly, when you go in the market, you can easily live when these small losses are happening, and you can have a chance to survive, and next day when your solution works, you make some good amount of money, right? So that's most important thing. I hope this graph clarifies what we're trying to do. There is another one, so that one was I think for Bank Nifty, this is for Nifty. So again, if you check here, look at this carefully, so we have profits and losses, and as we move forward, we are making losses, but we are also making profits, right? And that's how we are growing forward. The max amount of loss, we have capped it to the 5%, so that's very, very important. Okay, all right. So this is our Nifty, this is the Bank Nifty results. If you can see, this is a Bank Nifty results, which basically, this is our Bank Nifty results. So if you check, we have again our profits are about 3 times bigger than our losses. We are having little amount of trades here as compared to Nifty, only having 2 trades in every 10 days. That means 1 trade every week, and our accuracy is 62.57%. Okay. If we want to analyze, we can also go in detail and get all the data, all the trades which has been executed and in last 5 years, and we can analyze every single one of them. But most important thing I want you to understand from here is, when you are designing an edge on the system, you don't have to look to be 100% perfect, because you would never be. So you just have to make sure that whatever system you build is error free, all the biases and all the problems are sorted out, and after that, whatever is the best version you are having, you take that version live. But after understanding what is your risk reward ratio, how much money you are expected to make by average using a past data, and how the order is. And honestly speaking, the markets are uncertain. The complete market has uncertainty. What we are trying to do here is, we are trying to create certainty where there is uncertainty, right? And market can completely go against you, right? But what basically happens is, you are comparing 2 different people. Suppose there is one person who just closes his eyes, clicks on some stock name and places an order, or somebody gives him a call and he buys that stock, or you have a system which does that. The difference between these two is, a system will lose 1 day, 2 days, 3 days, 4 days, but 5th day it is going to win, and it will cover up your losses. Also, what should be your expectation. The person who is taking tips from people, following people, and getting information from somewhere else, or guessing, that person can never be certain about what's going to happen, how much he should keep his position size, how much he should lose. So most of the time he will end up with having a larger trade when market is against him and a smaller trade when market favors him. And I have seen so many such young traders, those who destroy their portfolio. So this is a mathematical approach where you know your numbers, and based on that you distribute it. If you see your stats are having a standard deviation of at least 10%, it's a red flag. There is something wrong. Definitely there is something wrong, and you should look at it deeply. What is wrong? Why system is not working the way it is supposed to be? And as I said, the approach which we adopt here is to use machine learning and artificial intelligence. What this does is it helps us to train our system and update our system every single day. So when market closes, we run our tests, we remove a faulty data. Let's say there are some cases when market is having fat finger issue, so some odd thing happens. I can also I'll make one video if you guys are interested on how to identify such wrong data, right? Sometimes something wrong happens in the market and data is completely odd. Like suppose market is falling and then suddenly 100 points jump. So these things are called fat finger issues. When something wrong happens with one big large trader or one big large trade, and it gives you a data, but that data is useless for your system, right? So there are a lot of mathematical way to ignore such data. So what we do is we ignore such data points from the data which has created today, and at the end of the market, algorithm learns from it, and next day it uses that plus the historical knowledge to basically trade. And what it does is it stabilizes our accuracy. So sometimes from 62 we go to 57, but sometimes from 62 we go to 65. The only thing which it does is it stabilizes itself. So we expect the solution which we have developed, that it will improve as it goes forward, and it will keep the consistency. Consistency is most important thing, so that you can be relaxed. You can be relaxed, especially when markets are there and your orders are open in the market, and you don't need to worry about it because you are using a stable platform, a stable hedge, a stable edge. These three things are very, very important. So let me give you a quick look of our solutions and what we are trying to do and how our platform is, right? So this is our Google Cloud platform which we use for trading, and this is instance 4. If you can see, we have multiple instances in different region. This instance 4 is specifically in Mumbai, in Google data center. So what this is the CPU rate. So I'll show you something. So let's say in this week, if I pull a data of this week, you can see these spikes, right? So these spikes are, if you check closely, from 9:30 or 9:15 to about 3:30. Every single day, the algorithm wakes up, executes, works, and then sleeps at 3:30 p.m. once market is closed, right? And it posts it after trading. It posts all our data into our website, where we store them, we analyze them for our purposes. So this is our Google Cloud platform, if you can see. And these biggest spikes which you see are when we try to do the code sync, or we try to upgrade or update any of our packages, right? So I hope you have liked our this video session. If you have any questions or any doubt which you would like to discuss, or if you're trying to build such systems, or if you want to invest in such systems or use solutions like mine, do not hesitate. If you want to reach out to us, you can go to our website, and on contact sections you can fill your details and comments. We keep all your data private in our cloud, and we do not share anything with anybody, right? So we will be happy to reach out to you back, and we will be happy to help you back. It's always pleasure to share our knowledge, especially if it helps somebody. All right, so till then, take care of yourself, stay safe, And I hope you make a good trades and good profit in upcoming days. Goodbye.